Charlie Munger, the vice chairman of Berkshire Hathaway and longtime business partner of Warren Buffett, has spoken and written extensively about the causes of human misjudgment. He has identified 24 common causes of human misjudgment, which include 1. Incentive-caused bias. This bias occurs when an individual's decision-making is influenced by the potential rewards or penalties associated with a particular action. For example, an investment advisor may recommend a stock because they stand to gain a commission from the sale, rather than because they believe it is a good investment. 2. Short-term emotion. This bias occurs when an individual's emotions in the short term, such as fear or greed, cloud their judgment and lead them to make poor investment decisions. For example, an investor may sell a stock in a panic during a market downturn, rather than staying the course and potentially reaping long-term gains. 3. Loving bias. This bias occurs when an individual is more likely to invest in a company or stock because they like or have a positive emotional connection to it, rather than because it is a good investment. For example, an individual may invest in a company because they have a personal connection to it, rather than evaluating its financial performance. 4. Hating bias. This bias occurs when an individual is more likely to avoid investing in a company or stock because they dislike or have a negative emotional connection to it, rather than because it is a bad investment. For example, an individual may avoid investing in a company because they have a personal grudge against the CEO, rather than evaluating its financial performance. 5. Doubt-avoidance bias. This bias occurs when an individual avoids considering alternative options or viewpoints because it causes them to doubt their initial decision. For example, an investor may ignore negative news about a stock they have invested in because it causes them to doubt the wisdom of their initial decision to invest. 6. Inconsistency-avoidance bias. This bias occurs when an individual avoids taking actions that would be inconsistent with their previous actions or beliefs. For example, an investor may hold onto a losing stock because they do not want to admit that they made a mistake in their initial decision to invest. 7. Curiosity gap bias. This bias occurs when an individual is more likely to be curious about a particular piece of information if it is not immediately available, rather than if it is. For example, an investor may be more curious about a stock that is not publicly traded and therefore harder to access, rather than a publicly traded stock with a similar potential for returns. 8. Deprival-superreaction bias. This bias occurs when an individual overreacts to the possibility of losing something they already have, rather than to the potential gain of something new. For example, an investor may hold onto a stock that is not performing well because they are afraid of losing their initial investment, rather than considering the potential gain from investing in a different stock. 9. Social proof bias. This bias occurs when an individual is more likely to take a particular action because they perceive that others are also taking that action. For example, an investor may invest in a stock because they see that many other investors are also investing in it, without considering whether it is a good investment on its own merits. 10. Authority bias. This bias occurs when an individual is more likely to follow the advice or recommendations of an authority figure, rather than evaluating the information for themselves. For example, an investor may invest in a stock because a well-known financial expert has recommended it, without researching the stock themselves. 11. Contrast-caused bias. This bias occurs when an individual's perception of a particular option is influenced by the options that are available for comparison. For example, an investor may invest in a stock because it has performed well in the past, without considering that the overall market may have changed and the stock may not be a good investment anymore. This bias can also occur when an individual is presented with options that are not relevant or comparable, leading to an incorrect evaluation of the option presented. 12. Hindsight bias. This bias occurs when an individual believes, after an event has occurred, that they would have predicted or expected it. For example, an investor may believe that they would have predicted the success of a particular stock after it has performed well, when in reality they did not have that information or insight at the time of their investment. 13. Omission bias. This bias occurs when an individual is more likely to take action to avoid a negative outcome, rather than to achieve a positive outcome. For example, an investor may avoid investing in a particular stock because they fear the potential loss, rather than considering the potential gain. 14. Ownership bias. This bias occurs when an individual values something more highly simply because they own it. For example, an investor may hold onto a stock that is performing poorly because they own it, rather than evaluating whether it is a good investment and potentially selling it. 15. Excessive self-regard bias. This bias occurs when an individual overestimates their own abilities or capabilities. For example, an investor may believe that they can predict market fluctuations and make successful investment decisions, when in reality they do not have the knowledge or experience to do so. 16. Over-influence of particularly attractive or charismatic people. This bias occurs when an individual is more likely to be influenced by someone who is particularly attractive or charismatic, rather than evaluating their arguments or ideas objectively. For example, an investor may invest in a stock because they are impressed by the CEO's charisma, rather than evaluating the company's financial performance. 17. Availability bias. This bias occurs when an individual makes judgments based on information that is readily available, rather than on all the relevant information. For example, an investor may invest in a stock because they have seen positive news about it in the media, without considering other potential risks or factors. 18. Illusion of control bias. This bias occurs when an individual overestimates their ability to control or predict certain events or outcomes. For example, an investor may believe that they can predict market fluctuations and make successful investment decisions, when in reality they do not have the knowledge or experience to do so. 19. Planning fallacy. This bias occurs when an individual underestimates the time and resources required to complete a task or project. For example, an investor may believe that they can quickly research and invest in a particular stock, when in reality it may take more time and resources than they anticipate. 20. Excessive coherence bias. This bias occurs when an individual sees patterns or connections in random or unrelated events. For example, an investor may see a pattern in the stock market that does not actually exist and make investment decisions based on that perceived pattern. 21. Confirmation bias. This bias occurs when an individual looks for and interprets information in a way that confirms their existing beliefs or hypotheses. For example, an investor may only consider information that supports their belief in a particular stock, and ignore information that contradicts it. 22. Self-serving bias. This bias occurs when an individual's decisions are influenced by their own self-interest. For example, an investor may hold onto a stock that is performing poorly because they do not want to admit that they made a mistake in their initial decision to invest. 23. Anchoring bias. This bias occurs when an individual's judgments are influenced by an initial value or reference point. For example, an investor may value a stock based on its initial price, rather than evaluating its current and potential performance. 24. Status quo bias. This bias occurs when an individual is more likely to maintain the current situation, rather than considering alternatives or changes. For example, an investor may continue to hold onto a stock that is performing poorly because they are comfortable with their current portfolio and do not want to make changes, rather than considering whether it may be a better investment decision to sell the stock and invest in something else. These biases can lead individuals to make poor decisions and judgments, even if they have access to all the necessary information. Understanding these biases and how they can affect decision-making is important for making sound judgment and avoiding errors.